Is the NASDAQ due for a correction? Here's what you need to know before the bell. The NASDAQ is obviously the star of the year, with technology stocks leading the way, of course, as retail investors are now jumping back into the market. They've been chasing these tech stocks in particular. But is the NASDAQ due for a correction? That's the big issue right now. And of course, looking at some of the technicals, we can make the case that that may just be the case here. Currently, the NASDAQ is trading about 20% above its 200-day moving average. Now, that may not sound like a lot, but historically, that has only happened 15 times since 1983. Importantly, the NASDAQ is trading well into 3 standard deviation territory above the 50-day moving average as well. Now, moving averages tend to act a little bit like gravity. So as prices move higher, these moving averages want to drag prices back towards that moving average. Now, that makes sense because in order to have a moving average, prices have to trade above and below that moving average over a period of time. In this case, we're talking about 200 days. So we need a period of time over 200 days where the market trades above and below that moving average. So again, when markets get this deviated above that moving average, there's a natural tendency to drag prices lower over that time to retest that mean, at least. And as long as we're in a bullish trend in the market should stay above that moving average during that time frame, as long as the markets are continuing to trend positively. So here's where we are currently. Market very deviated above the 200-day moving average. We're also very close to triggering a MACD sell signal, and we've already triggered one on our money flow sell signal as well. So that is already in place, suggesting that the market may struggle here to make further advances. Doesn't mean it can't attempt to, but most likely over the course of the next couple of weeks, we're likely to see the NASDAQ either stall out here and trade sideways and allow these moving averages to catch up to the price, or markets will start to correct back towards those moving averages as well, as that gravitational force starts to pull prices lower. But let's look back here over time and we can see what's happened previously when this situation has occurred. Looking back over a period of both bullish trending markets and bearish trending markets, we see that when such deviations tend to occur, the markets do indeed draft back towards that moving average. Again, going back to 2019, we have a period where the markets were extremely deviated above the 200-day moving average. We corrected back below that. Markets then rallied. Each time the markets have been as overbought as they are now, the market has experienced a correction back towards that 200-day moving average each and every time. So again, will this time be different? Most likely not, because whenever the markets have been both above or below that 200-day moving average, the markets tend to gravitate back towards that average over time. And so far, with the markets now back above the 200-day moving average, again, we are in a bull market because we have now changed that trend of negative prices when prices were traveling below the 200-day moving average to now prices trading above the 200-day moving average. That's the definition of a bull market. And now corrections back to the 200-day moving average or somewhere close will be an opportunity to add exposure to portfolios. But be careful here. Markets are very extended on a short-term basis. Be careful chasing asset prices here. You are going to get either a correction or a consolidation to allow a better entry point or a better risk-reward opportunity to add exposure to your portfolios. I'm your host, Lance Roberts, and that's what you need to know before the bell.